morning, everyone. Thank you for your time. It's a pleasure to be here. My name is Anh. I am the regional lead for capital structure and rating advisory at Standard Chartered. My focus is helping business like yours navigate the complexity of capital structure and capital allocation to ensure that growths are sustainable and the balance sheet is resilient in the face of change. Today, we will examine the impact of decarbonization on capital structure of shipping companies and how well-positioned balance sheets are to manage these impacts. We look at about 24 large ship owners and ship operators across different sectors, bulkers, containers, tankers, and offshore, and we look at the companies globally. So let's take a look. First off, I would like to make an observation about the valuations in the sector. We look at two valuation measures. On the left-hand side, we look at EV, so enterprise value to EBITDA, and on the left-hand side. On the right-hand side, we look at price to book value in relation to carbon emission intensity. And one thing I can say, it's fair to say, if you look at the charts, the higher up you go vertically, that means the higher the carbon emission intensity. And the further to the right as we go, it's a higher valuation. It's fair to say that today, valuations have not factored in any penalty to do with carbon emission intensity or the transitionary investment required to decarbonize. Is that a surprise? I guess probably not, because it's been quite challenging if you think about the 2050 net zero pathway. There's multiple pathways being developed. There's a lot of lack of clarity per se, and therefore it's not a surprise that you don't see any of that being reflected in valuations today. But will this stay the same? Absolutely not. There are regulatory changes and transitionary measures already underway or coming into action imminently. For example, we can think about EU ETS extension to the shipping sectors. We can think about the IMO midterm measures that are going to be adopted in the next year. So we cannot ignore. So how do we think about transition and how would it impact the overall balance sheet? Let us take a look. There are a couple of levers when you think about decarbonization in the shipping sectors. And aside, the obvious one like fleet modification, thinking about energy-saving technology, thinking about scrubbers, CCS. There are also efficiency measures, thinking about digitalization, route optimization. Alternative fuels, a third lever, remain very important in the overall decarbonization journey. And as we can see today, on the left part of the chart, you can see that alternative fuel take-up is very, very low. It's less than 1% of the global fleet today. That signifies the need for upgrades. And despite the uncertainty of which fuel pathways the sector will take, one thing we know for sure, it will be expensive, whether you think about CapEx or OpEx. The middle chart shows you an illustration of how much more expensive a dual fuel vessel, so we look at methanol dual fuel and LNG dual fuel vessels versus a conventional vessel. So that 12 to 15%, of course the exact number would vary by the type and the size of the ship. From an OpEx perspective, so that's a far right chart that you can see, there is a premium when you look at alternative fuel prices compared to conventional fuel oil prices, which are the dotted line you can see. How do we translate this onto impact on capital allocation of the shipping sector? That takes us to the next slide. Let me break this down for you. So Standard Chartered, we attempted to measure such impact of CapEx and OpEx over the medium term, so that 2024 to 2026, with a hypothetical questions. What if the order book today, which has a mix of conventional and dual fuel vessel, etc., is all converted into LNG dual fuel vessels? So we ran the analysis. That captures the potential higher OPEX from not just the fuel prices, but also the potential EU ETS charges. The analysis also captured the potential increase in capex, because if you want to convert everything in LNG into LNG dual fuel vessels, there is a 15% premium from a new build perspective. The chart shows you each of the columns. It represents the capital spendings of each of the shipping sector as a percentage of their cash flow from operations. So how much are you spending versus as a percentage how much you are generating internally. When you see the red dotted line, that's 100%. Whenever you exceed 100% of CFO, cash flow from operation, that means you are spending beyond your means. When you are very close to the line, that means you don't have a lot of headroom left. Whenever there is a funding gap, when you are spending beyond the cash that you generate, you can only do one of the three things. One, you draw down on your liquidity. Two, you raise more capital, and most likely debt. And three, you have to recycle capital elsewhere within your balance sheet in order to plug the gap. And each of the columns are split into two colors. And apologies for many, many different colors and lines and everything here. But what it represents is, if you see the dark gray, that is the original forecast of capital spending as broker estimates, so how the street thinks each of the subsector will be spending. And the green part is our own estimate when we run this hypothetical scenario and say, what if you have to convert everything into LNG dual fuel vessel? What if you have to go green faster? What would be the impact? And the outcomes are as follow. Number one, you can notice that there are meaningful green portions on the charts. That means, there is an increase in capital spending when you think about conversion into LNG vessel. There is meaningful capital spending when you think about transition towards the net zero future. The second observation is for some subsectors, and you, for example, can notice for tankers, there is a significant deficit that we forecasted. That's a little bit more than $7 billion, while for containers, there is a comfortable surplus of about $2 billion when you look at the forecast for 2024 and 2026. But this is not about the numbers and what exactly how they will turn out to be. This is really to make a point that as the whole shipping sector transition towards 2050, they will inevitably impact on your capital allocation and therefore on your balance sheet, because there will be funding requirement and you need to find ways to plug that funding gaps. And this simple scenario is only looking at the current order book, which is only 17% of the existing fleet. What if you have a bigger order book? What if your fuel pathway is something way more expensive? Then how am I going to manage all of these funding gaps? Shipping is as cyclical as it is. How am I going to manage all this investment requirement and meet the regulatory changes, regardless of where I am in the cycle? That is a question that I want to plan in your head as you leave the session today. And if you want to help answer with that questions, feel free to reach out to me. But it's not all bad news. We should take a look at where corporates are today in terms of the balance sheet. We think there's a lot of strength, as we can hear from the other speakers in the previous session, that can help the sector at least over the medium term based on our own estimate. So next part, are the balance sheets well positioned? I think Abhishek he mentioned before, liquidity is the lifeline, but liquidity is also a balancing act. And the first, we look at the liquidity of the sector. If you look at the green lines at the top, that represent liquidity as a percentage of gross debt across the 4 subsectors that we are analyzing. Overall, pretty robust, I would say. And in particular, if you look at containers, because of the historically high freight rates, it's normalized slightly in the past, but based on what I've just heard, I don't think it's going to come down anytime soon. The liquidity level of the container sector are very, very strong. Tankers, no different either. It's very high and increasing on the back of really strong oil market dynamics. How about the structure of that liquidity? That takes us to the bottom part of the page, where we break down liquidity into components. At the bottom of the stack is cash, which is the most liquid form. But we should also not forget about the other parts of liquidity. One is short-term investment, and the third one is undrawn committed revolving credit facilities that a lot of the shipping companies are able to take from banks. Two main observations here. Number one, both containers and tankers have a lot of room for recalibrating both the level and the structure of their liquidity. We think that there's a lot of surplus cash sitting on the balance sheet that could be utilized, especially if we just talk about decarbonization. Some of that cash can be used to invest into the future of 2050. Second observation, I'm not sure if it's clear for you to see, but if you look at the breakdown of liquidity of containers, the portion of short-term investment we've noticed that's come up significantly, especially over the last 3 years. That show that containers have been quite tactical in converting some of their liquidity into short-term investment form and make the most of the very high interest rate environment and enhance the return on their liquidity. Some food for thought if some of you have a lot of spare cash to think about. We then next look at the other part of the balance sheet, which is on the debt and the ability to service that debt. So let's start first at the bottom of the chart. We have bars that represent the net leverage of shipping companies over time. That's measured as net debt over EBITDA. If you can start first with bulkers, they've come down from historical height. In the recent 3 years, the leverage has increased for the sector, the subsector, but it's still nowhere near the full spectrum that we've seen. So it's relatively in a comfortable position over the last 5 years. Containers and tankers again stood out with very, very low leverage, indicating quite a lot of headroom should they need to actually level up at some point to make the investment into decarbonization or other types of investment. Offshore leverage has been relatively stable, but as a whole, compared to the other sectors, slightly higher. But I think with the positive outlook that we've heard, this is not really going to be a problem anytime soon. Debt affordability, which are represented by the top green lines, measured as debt service cover ratios, are again very robust. Containers and tankers again stood out at very, very strong in terms of ability to afford the very low debt that they already have. Now, all in all, balance sheets are in a really good position, and this has translated into very positive or stable outlook for the whole shipping sector when you think about credit ratings. We notice that credit ratings have moved across the curve from predominantly single B or lower if you look at 2020, to now actually more predominantly double B or even investment grade in some parts. And outlooks overall are stable or positive. And this is really in line with the outlook that I've heard from the MSI expert, Mr. Adam Kent mentioned before. Balance sheets are well positioned. So what does it mean? This is just to take everything together. This is a dashboard of the key indicators. I would call it winning indicators. As we look at the three measures, I would just recap. We looked at before the medium-term funding gap, especially incorporating potential impact of decarbonization. We have looked at liquidity strength, and we have looked at leverage and the ability to manage and afford that leverage. And all in all, the only sectors you can see with the red winning is tankers with a very high funding gap, but their liquidity and leverage are well in check, and they are strong enough to actually weather this. So what is next for the sector, and what are the actions should shipping companies be thinking of as you are steering towards the 2050 net zero target? Here are our recommendations. For the bulkers and offshore sector, to manage your leverage, and if there is a situation where things don't go as planned and you actually have to manage a much bigger funding gap than you expect to, there are two levers you can think of from a capital structure and capital allocation perspective. Number one, reprioritize your capital allocation. There's a lot of discretion we notice within the industry about bringing back some of your shareholder return distribution and reprioritize capital allocation towards preserving the balance sheet or towards investment needs. So that's number one, capital allocation reprioritization. The levers number two, and we've particularly noticed that it's a quite a useful one in the offshore sector, is really thinking about diversifying your debt mix into something that, for example, more debt neutral. So we've seen a lot of hybrid capital raising within the subsector of offshore, because it does help to plug the funding gap, but it doesn't create so much pressure on the leverage. How about the other two sectors, containers and tankers? Just requoting Abhishek again, even though liquidity is a lifeline, it is also a balancing act. And we think there are rooms for, again, re-optimizing both the level and the structure of that liquidity for these two sectors, especially spending some of the surplus cash towards investment for decarbonization would be quite useful, especially for tankers who are facing quite a bigger funding deficit when you think about a cash flow perspective before. So, is there a sea of change? I would say absolutely yes, but the ship is on course and is moving steadily forward. And with that, I conclude my presentation. Thank you very much for listening.